get closer to.
All right. Good morning, traders. This is Blake Morrow, and you are listening to the FACE webinar. And we do not have Dale in today. He's having some internet issues at home. His internet provider had something with their routers and yada yada yada. Anyway, he'll be back tomorrow. But I just wanted to double check. Let me know if you guys can hear me. Let me see if I can get to the Q&A panel.
We can hear you just fine, Blake.
You can hear me fine? Okay, very good. I just want to make sure that everybody can. Umar says you can hear me. Okay, great. All right, so obviously a very, very, very busy overnight session, very busy weekend. Let's talk a little bit about everything. Now, I'm just hoping you guys were listening to the week ahead video, and it was really set up perfectly for the US dollar CNH to break out, and based on the rhetoric about the new tariffs, it was just a matter of time before the US dollar CNH broke out. And obviously they adjusted the price over the weekend and or on first thing Monday morning in China. And so the US dollar CNH actually broke out, and that was the catalyst or the driver for the US dollar Japanese yen to break down into new lows. Now, what you'll notice going back to the US dollar CNH is the US dollar CNH is actually holding above 7. Now, if you're sitting here looking at the US dollar CNH going, well, it's probably going to come back down again, I doubt it is. I don't think it's going to go back down from here. Why would it go back down from here? If China wants to hold the US's feet to the fire, they're going to do it via a currency, this currency, and play a currency war in this fashion. So as long as the US dollar CNH is above 7, above this exchange rate, you have to know that the China-US trade war tensions are very high. So unless you see that US dollar CNH come back below 7, I don't think there's any reason to believe that things are improving. All right. This is going to be our barometer or our gauge moving forward on the US-China trade war front. All right. This is their, for lack of better terms, this is going to be their trump card in this trade war. All right, and that's the key.
Nice one.
Hey, that again, this is not that was not intentional, but it just kind of came out that way. But this is their trump card, right? This is their. As long as things remain heated, we're going to just keep this exchange rate elevated, which means we're going to suppress our currency. So what you should be thinking at this point is, oh my gosh. What should I be doing with these yen pairs, and what should I be doing with, hold on, my speakers are pretty loud from my office. Hold on really quick. Okay, I had to turn that down just a bit. What you should be doing in the FX market, and I'll tell you, I have covered up my US dollar Japanese yen. I was pretty aggressively short on Friday, and I scalped the US dollar Japanese yen on the short side probably about 5 different times last night. And I'm done. I'm out for right now. Now the question is, you're probably thinking, and let's talk about this for a second. And this is where a lot of new traders get very confused. And this is where a lot of traders just in general get confused. All right. I am not short the US dollar, Japanese yen anymore. Does that mean I want to be long? Answer that question for me. Just because I covered up my US dollar, Japanese yen shorts, does that mean I want to be long now? No. And you guys, and here's the thing, people ask me this all the time, and it's maddening, but it's just a normal question. Well, Blake, if you don't want to be short, you must think it's going up. So why don't I just go long? Why don't you just go long if you think it's going up? You know, that's not necessarily the case. Right now, the risk reward does not favor being short at this point. Does that make sense? I want to be short. I think it's a great short overall. Like if I short the US dollar Japanese, okay, let me take a step back. Do I think that the US China trade negotiations are going to improve from here? Personally, I think, and I'm just going to give you my personal opinion, and opinions are like buttholes. Everybody's got one. So, I'm going to give you mine, although I won't let you see my butthole, but I'll give you my opinion. My opinion is this. I think Donald Trump is going to prolong this trade war with China into the election, because he's going to stand on and this is all politics now. He's going to say that no one else can. Do you want to hire, or do you want to elect a Democrat that's going to deal with China, or would you rather have me? And so I can fix this mess that I created, right? That is my opinion on how Donald Trump is going to be playing out the next 12 months. The China-U.S. trade war is going to be heightened, and he's going to say, "What do you want? A weak Democrat to deal with China, or you want me?" Right? That's what he's going to run on. Now, I may be wrong, and maybe he tries to fix everything and make everything great with China, U.S. Tensions between now and then. But I don't think that's the way he's playing. That's my opinion. It doesn't make me right. Doesn't make me wrong. It just, that's my opinion. So therefore, if I think that the China-U.S. trade tensions are going to remain heightened, I want to play the U.S. dollar, Japanese yen on the short side. However, I just don't feel that right now is the perfect spot to be playing on the US dollar, Japanese yen short. What I think is going to happen, and this is me personally, and again, this is not saying this is going to happen. I don't have a crystal ball. I don't I'm it's this is just how I'm going to try to play it, and I might have to chase it. I'm going to try to wait for a US dollar, Japanese yen bounce and then play it on the short side. That's how I want to play it. Okay. But the question that is always posed to me at this moment is, well, Blake, if you're not short, you must think it's going up. Why don't you just get long? And that is just not the case. That's not how I trade the markets. You might trade the markets like that, and I think that's a very dangerous way to play, but hey, to each his own. I'm just telling you how I'm approaching this situation. And also, I'm not a person that wants to just piss away a truckload of gains that I've made over the last few sessions, which, by the way, I've done what I usually do in a month in like 2 days time. So I realize that I've done pretty well. So I'm, kind of taking a step back, reassessing the situation, looking for better opportunities to be in the market versus right now where things are a little iffy. All right, now let's talk technically. The US dollar, Japanese yen, as we discussed on the week ahead video, we are at very key support. You can see this little red box here. I drew this box during the week ahead video yesterday morning, like less than 24 hours ago. We are consolidating basically at that spot. And this is a pretty key level or, support, because it's the triangle support excuse me, in the dollar yen, we hit the 127% extension. We're below the 78% retracement of this big move here. And right now, I think we're just consolidating. Like I said, I think that while the US dollar while the US dollar CNH is above 7 on the exchange rate, the risk of a US dollar Japanese yen continued sell off is high. I just know we're at really key support. Therefore, I don't want to be on the short side right here, right now. Okay. Because I think there's going to be this is a very pivotal area. There's going to be a lot of two-way trading action around these prices. And why get stuck in the crossfire, right at this moment in time? All right. Now, a couple other things that are happening, and then I'm going to bring in Steve's here today. He's back from his vacation. I'm going to bring him in about 15 minutes. But I want to bring Stelios in about 5 or 10 minutes so I can get his opinion on what's happening with the U.S.-China trade situation. He does have an ear infection, so when he pops on, I will scream just to see if he has his earphones on. But let's talk about the euro dollar. So as I warned you guys on the week ahead video, you don't want to be short the euro because we had a false breakdown and the euros had spiked up. Now we are up against resistance here. You can see the resistance around the 111.80 to 112 area. If you watched the week ahead video on yesterday, and you're like, ooh, wow, I'm going to play the euro on the long side, because that makes a lot of sense what Blake said on the video, and you played the euro on the long side, I would be a little careful right now. I don't know if I'd be long here. I'd probably be taking profits off the table.
Plus,
does that mean, hold on. Does that mean I want to be short? So again, this is the same question that I posed with the US dollar Japanese yen. Just because I don't want to be long the euro dollar right now doesn't necessarily mean I want to be short the euro at this point in time either. All right. This is a moment where I look at the FX market, and I'm sure there's some great opportunities. I could share maybe one with you, or if I don't have time, I'll share it with everybody in the ForexAnalytix community in the chat room. I'll tell them what I'm thinking here. But this is a point in time in the FX market where I don't think there's great risk reward if you haven't taken trades already. Like, I'm looking around at the market right now going, yeah, I don't know if there's anything right now where I look at the market and I'm like, I want to take a fresh new position, long or short anything at this moment, because we are a nice crossroad pretty much on most of the majors. Now, Steve just couldn't control himself. He's missed being on the webinar for the last week, so he had to say something. Go ahead, Steve.
You just interrupted me interrupting you, making some humor that they can wire part of those profits to you.
Okay. that they could probably, but this is you get into a point where things get really tricky, and if you didn't take action on Sunday night after watching the video, the week ahead video, soon as the market opened, buying the euro or shorting the dollar yen when at the open, if you didn't do any of that, or closing up some dollar yen as we drop below 106, this is probably a very tricky area for most of the majors, where you have to look around and go, shoot, I don't even know what to do, because now we have a situation where we have like the Kiwi dollar. It's like, okay, it's way weak, but a little too oversold to be shorted, yet it's too weak to be bought. And I have employment data out of New Zealand tonight. Nothing I want to do there. Then you got the Aussie, and you go, wow, the Aussie's so oversold right now. Maybe I want to be long, because maybe we might get a little reversal, but yet it's so weak, I don't know if I really want to do that. And you have the RBA coming up tonight, right? You have the RBA decision tonight. So it's like, okay, well, I don't want to do anything with that. Then you got the dollar Canadian. You're like, oh, hell, I don't even know what to do with that. You got the US dollar Mexican peso. It's like, oh, well, I didn't buy it overnight when it cleared the 200-day moving average. Do I really want to chase it up here as we're at 1960, where this is the place that Blake actually wanted to target the dollar Mexican peso, but was too much of a wussy to hang on the whole way, which is a true statement. But we already hit that that resistance. So do you really want to be, long the dollar mex right now? No. But do you want to be short it? Well, I don't know about that, because stocks are so weak that it could push us up towards 20. So that we're at areas where I don't know if it really makes sense to be establishing new positions at this point, because it's very, it's things are either they've gone too far, so you don't want to be quote unquote chasing the market at this point. Yet, things are so weak or so strong, it's tough to stand in the way of those trades. So anyway, I'm just giving you guys some food for thought. And like I said, I don't think there's any reason to be long the dollar yen right now. Does that mean I want to be short at this moment? I'd like to be short. I think if I shorted the dollar yen right now and I close my eyes, I actually think if I shorted the dollar yen right now, I close my eyes, I open them up a month from now, we'd probably be trading down here somewhere. That's personally, I think that. But the question is, between now and a month from now, do I think I could get a better price being short the dollar yen? That I do. So therefore, I'll, try to wait for a better price to be short the dollar yen, like maybe 106.80 or something like that. All right. So I hope what I'm saying to you guys this morning is making sense. Does that all make sense, what I'm saying? Am I making, sense to you guys? Because I wish I could get on the webinar every day and go, oh yeah, you look, this is a real look at the risk reward here. It's perfect. It's just not that way. That's not trading. Trading's not, perfect market conditions at all times. I think we had some great opportunities the last 24 hours, and I hope you guys had the opportunity to take advantage of them. But what do we do from here? It's tricky. It is tricky. So let me bring on Stelios really quick, because I know he has an ear infection and probably wants to, rip his.
Hello.
Hey, how you feeling?
I'm good, actually. It's not too bad.
Oh, okay.
It's
all right. All right. I thought you might have had to slip on your daughter's ballerina slippers there for a little while. So what's happening? What do you? I know you're on the island. How do you feel about the China-U.S. Trade escalation here, and what China's response has been? What any thoughts?
Well, first of all, for people
I'm sorry. And you know what? I got to mention one last thing, Stelios. For those of us that live in the United States, it's been a really sad state the last weekend. There was 2 mass shootings here in the U.S. and I had to recognize that, because here I am. I live in the United States. I sometimes feel that I live in a little bit of a bubble in the place that I live, but that's the reality. Is it's a very sad weekend for the United States, for the gun violence that is continuing to escalate here in the United States, and I don't think there's any simple solution. It doesn't matter if you're a Democrat or Republican, and if you're pro-gun or anti-gun, or bottom line is our Constitution in the Second Amendment says that we do have the right to bear arms, and so therefore, as Americans, we do. It is a scary situation what we're dealing with, and I just want to recognize that if anybody is directly affected or even indirectly affected by what has happened over the weekend, my condolences. And it's a very sad state, and I am a gun-toting American, ex-military person. So I do have guns, and so I don't want to get in a political discussion, because that's not the place. This webinar is not the place. I just had to recognize that. Sorry, Stelios. I meant to mention that before.
That's fine.
So okay. So anyway, welcome and please continue on. I'm sorry that I had
no problem. No, it was sad to hear all that for sure. So basically, for the people who are not aware, Donald Trump basically announced another 10% of tariffs on what I think is the remaining 300 billion of Chinese export. I think with this, there's going to be a tariff on pretty much everything coming in from China. And he did say also that it's going to slowly escalate to 25%. Now, what does that mean? It means, obviously, we've talked about it before. These tariffs, essentially, they are a burden on the consumer in the end, the American consumer, because the goods imported are going to be more expensive. It's very interesting to see China's reaction, because you have two sides. You have Donald Trump, who's firing from his phone and on Twitter, and then firing all these tariffs and everything really aggressive. And you have the Chinese on the other side, who are much more, at least to me, they seem a bit, much more restrained but effective. So what they've done is, first of all, they have let the yuan go past the $7 mark, and today it's being devalued by about 1.5%. So effectively, it's offsetting some of this, some of these tariffs. They're using this as a weapon, although they explicitly said today that they're not using it as a weapon. Well, from what I can see, I can personally say that they are using it as a weapon. But anyway, this is what they say. The other thing that happened is that the state-run agricultural firms in China have stopped buying American farm goods. So this is the Chinese reaction to all this, because let's not forget, they're supposed to be in negotiations, in trade negotiations, and Trump is always using this aggression. Is it right? Is it wrong? I've said it before. We don't know yet. It might turn out to be the right strategy, but you're negotiating with somebody and you are, pulling out the revolver and setting it on the table. It's probably not the best way to negotiate, but it could be effective in the end. But anyway, bottom line is we have this escalation. Stocks clearly don't like it, and like Blake, you said, I think quite correctly, this might drag on until the elections. And
it will.
Yeah, and actually, the other scenario is it might drag until the elections, and Trump might, just before the elections, say, strike a deal or do something constructive, and to show people, look, I know how to deal with these people. I know how to bring America forward. So maybe, I don't know how it's going to happen. The end game is going to be, but I think you're right. It's going to go all the way up to the election. So we have to.
You know what's interesting. So here I'm gonna bring this is a ForexAnalytix chat room, guys, and for those of you that don't. If you're part of the ForexAnalytix team, or a member, you guys can say hi. You guys are all on Jumbotron. Those of you that are listening in, you guys can say hi real quick. I'm going to show you this picture. This is me Friday, by the way. Let me get to it right here. This is me Friday, and I was playing golf at Desert Mountain Golf Course, which, by the way, is like one of the nicest courses I've ever played on in my life. There's 7 courses in this community, and this is really far northern Arizona. It's a very expensive community, and that was the kid that I was playing with, and you can see him there. He's the young trader Jack, who's been sitting with me for the last he sat with me for like 2 weeks over the summer. Played with his dad and one of his dad's partners, and there's a reason for the story, and I'll tell you guys. One of his father's friends who lives in the community, he's the president of a software company who has a presence in Korea, a factory in China, and he has over 2,000 employees, and his office, or his main office, is in Irvine, California, and then they have an office here in Scottsdale, Arizona. Anyway, we were discussing, it was really interesting having conversations with this guy, and we had lunch together, and I'm not going to tell you who he is. The company is a publicly traded company, by the way, and his opinion about China, it's really interesting to hear his point of view, because he has moved one of his factories from China to Mexico, and he makes chips that go in, smart TVs and also in remote controls for DirecTV, Comcast, all the remotes that you use for like for cable. And we were just discussing like tariffs and everything else. And and it was funny. I told him actually on Friday, I'm like, yeah, you got to watch the US dollar. Renminbi, they're gonna weaken it, as a response. And ironically, they did, obviously yesterday. But the conversations that we had, be quiet, Amir. I'm gonna get rid of you guys now. I could see his comments there. That you guys can all read his stuff. The bottom line is that his opinion is, and obviously he stays in touch with a lot of Chinese people that are in the know, being a very and he's like, we're not even a big software company. It's like we're a small to medium sized software company with 2,000 plus employees. He's like, but his opinion is very much what you just said, Stelios. Is he thinks that China is prepared to deal with Trump, and they're going to try to weigh it out. And he thinks that they're going to wait it out because they want to hopefully deal with the next administration, and they hope it's not Donald Trump. So they just want to make sure that they can survive over the course of the next year and a half, and as there's a transition. And they won't even deal with Donald Trump from here on out. And if he is reelected, at that point, they're going to go back to the negotiating table. That's his opinion of what China is going to do. And I think that's interesting because I do happen to agree that they're now hunkering down. And my 2 cents is, and I'm going to play devil's advocate here. If I was China, I would play the Russia card. I would try to meddle in U.S. politics because we can obviously see, that the door is open there. So if I was China and I didn't want to deal with Donald Trump, I would try to alter how things end up. So,
Blake, one thing I wanted to add is some weeks ago, this trade war has been going on for weeks and weeks. A few weeks ago, I remember reading somewhere, one of the Chinese officials actually saying that, look, if this thing gets prolonged and goes on and on, our government is going to be there and enable us to stick to the very end or something like that. So, they have the means and the willpower, and as a collective, as a government, to do whatever it takes, basically. And that's really powerful, in my opinion.
Yeah, and I think they do have the staying power to wait it out as much as possible. Anyway, guys, we're chatting about a lot of things that are, relevant to the situation, but market related. Like I said, if you're long the euro, you got to be a little careful up here. We're right into the resistance zone. Does that mean it's great short? Well, you guys can figure it out. I personally, I'm kind of sidelined at the moment. I will tell you this, with New Zealand employment coming up tonight, the RBA tonight, and then RBNZ tomorrow. You guys should probably be watching the Aussie New Zealand while we're down here towards channel support. That would be my one thing that I'd be watching down here. We're really near some support here, and I think the market's pretty aggressively short Aussie dollars because of everything that's happening. I don't know if I'd want to be short the Aussie as we're so close to the support down here. I'm just going to say that and leave that with you as Steve comes on. So Steve, welcome back, man. We've missed you.
Thank you. Missed you as well.
Yeah. How you feeling? Rested up mentally?
Oh, mentally, yeah, relaxed quite a lot. Spending 1 week off the grid, does wonders after almost a year that,
Sure.
day out, in the markets, on the internet, work stuff. So, relaxation and, going away from that is really helping your mind, reset in a sense, right?
We do need that. Yeah. So we need that, that de-escalation. I did that in Montana. It was really good for me just to be off the grid for a while. So that's good. I'm glad you are a little refreshed. So I'm sure you have all sorts of opinions on what's happening here with the China-U.S. situation.
I don't disagree much. My point of view is somewhat tweaked. I think that one of the reasons that Trump is not going ahead with it is because he overpromised it. He promised like a big win in this trade deal. He knows that he can't get a trade deal that, can be produced as a big win. That means that he has no intention of bringing it in on time. But I think that one of the reasons that the Chinese are very patient and very careful with their statements is because they know that if the market forces Trump to produce some kind of a trade deal in order to help stocks survive until the election date, then he would be willing to produce a trade deal, even if that's not good for the US. He's going to present it as good, and he's going to hope that one way or another solving the situation is going to be enough to prop the market and get the animal spirits moving again, even I don't know for how long that's going to work. So I don't think that it is impossible for Trump to have to be forced to produce some kind of a deal in advance. And I think that the Chinese are very careful with their statements, so they don't actually, make it impossible for something like that to happen. I think that they see there is a possibility for something like that to come on the table necessarily if the markets sour, especially closer to the elections. Trump is going to be striving to hold on to anything. And, that might be something that will help for sure. And at the same time, he's obviously using this to force the hand of the Fed, because the Fed doesn't have anything tangible to produce so far to excuse the beginning of a new easing cycle. So, producing something like that, escalation having to do with trade wars and, foreign relations and trade deals, at least works as a decent excuse for the Fed.
Yeah. Interesting. It's gonna be interesting to see how the world plays out from here. But hey, I just want to point out that because ForexAnalytix asked about the S&P. The S&P is sitting on trendline support. We're nearing a 50% retracement. We've had a nice fall in the S&P. I think we're going to consolidate a little bit here. But also if we start breaking through some of this, like some of these lows down here around the 2870 level, somewhere down in this neighborhood, you got to be a little careful with equities. But hey, Steve, I'm gonna pass it over to you because I left you a whole lot to talk about, a lot of charts to go over.
Absolutely.
And I want to say thank you guys all for being here today. And make sure you stick around with Steve and Stelios. We don't have a guest today because Coach moved his guest that was today to Friday, which is Jim Welsh, which is he's a really great macro guy. So we didn't, since they're personal friends, we wanted to make sure that Dale had the opportunity to interview him on Friday. So I'm gonna pass it over to you guys, and I'm gonna stop sharing. So Steve, it's all yours. And guys and gals, thanks for being here today, and make sure you visit Forest Park FX, our webinar sponsor. And thanks everybody.
Thank you, Blake. Thank you.
All right. Have a great one. Steve, welcome home. Welcome back.
Blake.
All right.
Forest Park FX is definitely the choice to be having to do with an introductory broker. You have nothing to lose, just to gain. I'm a client of theirs. You can get cash back or subsidizing your ForexAnalytix subscription. And they know the industry upside down, and they can help you make the best choice, having to do with your trading style, having to do with which broker you want to be using. Depends on your account, on your trading style, as I said, on your time horizon, and a lot on your account size. So yeah, I definitely suggest that you give them a Skype call or send them an email, and you can see what they can do for you, even for getting some free advice. I mean, it's always good. Okay, so back to the chat. Stelio, did we have anything else besides talking about the US-China trade deal. Do
we
have
had some, well, not minor. We had a bunch of services PMI readings, none of which surprised massively either side. We had some good and bad numbers like Japan, China, the Eurozone, slightly worse, and Italy and sterling, and the UK slightly better, but really not much else of note. And we do have ISM, non-manufacturing PMI, later today. But other than that, we didn't have anything.
I think we had major event risk during the past couple of weeks, and we don't have like super major stuff coming up. Yes, we have some Australian and New Zealand news this week, but nothing as heavy as what we had for the last part of July, right?
Yes.
Okay.
That is true.
So there is a decent chance to see the moves that began last week extend, since usually if you get something moving after event risk, and there is no other event risk that can really reverse things, there is a decent chance for a continuation. So I think we have to start looking things through that aspect. But as Blake said before, the fact that some things have moved and some of those moves look to be impulsive, which means that even if they are part of a bigger correction, they should at least extend lower over the next few days / weeks. That doesn't mean that there is always an appealing risk-reward ratio, because don't forget, it's not about having a point of view, it's also about having the proper money management, and money management is all about risk-reward. So if there is no risk-reward, then there is not much to do. For example, if you didn't short the S&P when it broke below 2960, if you remember the week before the last one that I was here, I kept saying that having to do with the S&P, everything is about 2960. As long as we remained above 2960, there was no event to be talking about having to do with the downside. But once we did break 2960, it was definite that there were a lot of stop losses in place there, and we should see an extension lower. So that has happened. We broke below it finally. We did extend lower, but now we're approaching a confluence of supports, roughly at 2870. So being at 2886, okay, you might expect that there is more downside for the S&P, and I do think there is more downside. I mean, even if we have some type of a rebound, I think that we should see some kind of a move like this. Okay. Even if this is a correction, it should unfold somewhat like that. But would you be selling it today, here, ahead of the 2860, 2865, 2870 area? No, because it makes no sense. Where would you place your stop loss? I mean, for any short to make sense, where we stand, I don't see any real resistance. There are some soft resistances, but any real big resistance until 2960. So if you sold here, you would need to have a target, a valid target that would make sense with a stop loss above 2960. And as I said, since we have a confluence of supports coming up, just like roughly 20 handles below where we currently are, the risk reward doesn't make any sense here. Having said that, yes, I do think that a rebound towards 2960 is probably going to be an excellent opportunity to see more downside. Here's the Nasdaq, by the way. Nasdaq, the key level for Nasdaq here is roughly 7460, 7480. We have the 50% fib of the last move higher there. We have some horizontal support resistance area. We also have the beginning of this ascending wedge. Don't forget that when an ascending wedge breaks, theory suggests that we should fully retrace that wedge. The beginning of that wedge is roughly there as well. So, Nasdaq, more downside to come, but the next big area of support is not that far away. So again, if you don't already have exposure here, there is not much to do at the moment, because you will be probably risking a lot more than you are to gain before we see some kind of a rebound, right? A corrective rebound, perhaps, but a rebound nevertheless. Here is the VIX, by the way. If you keep noticing, it is extremely subtle, but the VIX has been producing higher lows since November 2017. Think about it. It's a huge period of time, right? It's a huge period of time. I mean, it's going to be in a few months, it's going to be 2 years. So stocks have been pushing to new highs until a few days ago, with the exception of the Russell. And I want to make a specific mention on that. But the VIX has been for all that time showing us something different. And I think that the VIX has been confirming what I have been saying for all that time, that we are at the last phases of this business cycle. I actually made a bet several months ago with my friend Dures that we're never going to see single digits again on the VIX during this business cycle, right? Who knows what's going to happen in the next business cycle, but not during this one. So that doesn't mean that the VIX is going to explode higher from here. But even if we get over this corrective phase, which is extremely likely, I mean, we're still in an uptrend, and we know that they're going to do everything possible to extend this business cycle until election time. That's not Trump's doing. Every single president up to date has been doing the same thing. It's not something specific to Trump. Once you are in power, you want to stay in power. That's a common denominator between almost every human being, definitely every politician. Okay, so even if we see new highs, in my opinion, we're going to keep seeing this subtle divergence in the VIX. So the VIX can definitely come down again. Will it go back to single digits? In my opinion, no. It's never going back to single digits during this business cycle. During the next one, after we get a recession or a big move lower, whatever, sure, it can again. But I don't think during this one. Anyhow, the VIX keeps producing these type of formations, as you see, descending wedges. So a cooling off period, an explosion higher, descending wedges, an explosion higher. As you see, this is a recurring pattern for the VIX. Now, big resistance for the VIX remains the 25-26 area. Now, I said that I'm going to make a specific mention about the IWM, the Russell. As you know, opposite to the three popular main indices, the Dow Jones, the S&P, and the Nasdaq, the Russell is more focused on companies that are affected by the local economy. So, in my opinion, sometimes it's easy to do some fact checking. So the Fed is trying to persuade Trump as well, but I'm going to focus on the Fed having to do with monetary policy. The Fed is trying to persuade that it's okay to go back on doing some easing. Why is that? It's not because the US economy is not in a good shape. It is simply because we have outside forces that have to do with the global economy plus the trade war that are putting our economy in some kind of danger. Okay, question. Then why aren't the globalized US indices underperforming the Russell? If the health of the US economy is as good and the only dangers are coming from the outside world, why isn't the opposite happening? The Russell should be doing amazingly, and indices that have so many companies that actually create so much revenue from other countries should be underperforming. So the Nasdaq should be lower, shouldn't have made a higher high. The S&P shouldn't have made a higher high. Somewhat the same applies to the Dow Jones, but the Russell should be pushing to all-time highs again and again and again. But that's exactly the opposite of what we were seeing here. So, among other things, allow me to be very, very skeptical in this interpretation. I think that the US has many endogenous problems as well. I'm not saying that the other economies don't, they absolutely do. And we can see this depicted in this index. Now, this clear divergence also leaves a lot of room for more downside. Okay, we see now the Russell has been stuck in a long period of time. Actually, throughout the year, the Russell has spent all this time consolidating between 145 and 160. You can see it here in a range. So I do think that once this range breaks one way or the other, the Russell should extend one way or the other. This is a rectangle in essence, and theoretically speaking, from a technical perspective, we should see an extension. The range is roughly, let's say, 15. We should see an extension either to 175 once we break above 160, or if we do break below 145, we should see an extension towards 130. As simple as that. Okay, until that happens, Russell is in a range, so range trading it is. Now, DAX failed miserably. It was doing, from a technical perspective, well, up channel, corrective move lower in a clear ABC, another move higher. But now we moved lower, we rebounded, we never made it to the highs, and now we're seeing a move lower that looks rather impulsive. It's not only how many days we've had in a row that we've been moving lower, it's also that we see momentum accelerating the downside, and as you'll see here, almost the same thing happened with the FTSE. The divergence here with the FTSE, British pound is to blame for that, was that the FTSE did make a new high when the DAX was not making a new high. So that was a nice divergence. That's why sometimes it's beneficial to monitor divergences between similar assets. So in this case, we had a divergence. FTSE was making a new high while DAX was not confirming. And now we've seen this move lower. This is the fifth consecutive move lower. As you see, every single day shows stronger downside pressures than the previous one. Okay, so I think there is more downside to come both for the DAX and the FTSE. Now, once again, here I don't need to state the obvious. After 5 consecutive days down, there is no risk reward to sell them here. Would be nice to see a rebound to sell those, something like this, for example, if we take the FTSE as an example, okay, something like this, or if you want to be looking at the DAX, switch to it. DAX, by the way, breaking below the 11,800 level once again, also very significant. You can see this 11,800 area has been key support resistance area multiple times in the past, so it is a significant level to watch. Keep in mind, though, that today so far, we've stalled at the 200 daily moving average. Okay, as you see, if you go back to the chart, the 200 daily moving average has acted as resistance here or support here, and so far here multiple times. So obviously you're not going to be selling this index right on the 200 DMA, but here as well, the move lower is quite nice and robust. So I think that any decent rebound to a support resistance area is going to produce a nice selling opportunity. Here is the Nikkei as well. Last time we had a look at it here on the webinar, we were testing this horizontal support resistance area. So as usually when there is, in essence, a crossroad in the markets, I mark that, we either break higher from there and extend, or we get rejected, in which case, we plunge lower towards the next support. Second thing happened, obviously, when you are in a juncture, in crossroads, the risk reward is always being in the direction that there is more room to run. So since we were testing resistance purely from a risk reward perspective, being short makes sense. You can be short by risking very little because you're going to know very fast if you're on the wrong side of the market. Okay, now we've already broken the next area of support as well, which means that the next area of support is roughly at 20,250. We're not that far away anymore. So here as well, the risk reward ratio is not there anymore. But if we make it down there, for example, and we rebound to retest 21,000, then I think that's going to be a decent selling opportunity here as well. Okay, now Another one I wanted to show, and this was one of the better opportunities that I was monitoring for a long period of time. I took some trades while I was on vacation, but that was not one of them. I would, when I'm on vacation, I would only do the rare trade on some mainstream stuff. I was closely monitoring the Australian stock index. Why? Because it has such a clear pattern here. You can see this, right? I mean, it's not by random that the market creates patterns like this. I mean, whenever I find somebody that is just purely macro based and they don't believe at all in technical analysis, I show them charts like that and ask them, okay, what is the possibility that the market will randomly create a channel that large? I mean, this channel dates back to 2008 and respects so many times two trend lines, right? A support and a resistance trend line. I mean, what are the chances that something like this can happen coincidentally, accidentally, randomly? In my opinion, not many. So I was very, very closely monitoring this uptrend that started at the very end of December. Don't forget, I've talked about multiple times about seasonality, how likely it is to find a significant high or significant low at the very, very beginning or at the very, very end of a week, a month, a year. Of course, the bigger the time frame, the more important it is. So we've had this almost now 8 months, oh, not almost, actually an 8-month uptrend, which was, very, very strong. But I was looking forward to the opportunity of making it to resistance. Now, we didn't exactly make it to the pip to the resistance, but we came very, very close, and now we're reversing from there. I don't see any real significant support until we go back to 6,520. And after such a move, I think that the risk reward is still favorable to be short. Don't forget, we almost made it to the resistance of an 11-year-old ascending channel. And even if we wanted to retrace part of it, that's still like a huge move. Okay. So just look at today's candle here. It's massive. So I do think that one of the better looking indices out there to trade is this one. And although I know that many of you don't even monitor it, I monitor. Yes, yes.
Sorry to interrupt. Carry on with that. Just after you're done, because you were talking about the Aussie, one of our friends in the chat room is looking for, would like to know your opinion on Euros, if you can afterwards. Okay.
Oh, absolutely. Euros and Euro Kiwi. Ooh, impressive. I can tell you that much. Very, very impressive. Because, first of all, from a technical perspective, once again, this trend line saved the day, because I was closely monitoring this ascending purple trend line to give me confirmation that Euros is breaking down. Because once Euros would confirm that it was breaking down after this move that started in the beginning of 2017, then there would be a lot more downside. But if you look at this trend line, we flirted with breaking down from it. I mean, we were barely just below it, but the market had clearly stalled there. And then this amazing rebound happened. And in all actuality, we now see the exact opposite thing happening. We're now breaking above this ascending trend line. You can view this as a huge wedge. And that definitely has bullish implications. In fact, if we FIB extend the last corrective move lower, there it is. Now we can delete that. It's worth it anymore. You can see that, upside targets now are the 127% extension of this last corrective move at 166, and then the 161.8% extension almost at 168, at 167.91 to be exact. So I think we are having a major technical event here, and you need to respect that. Euro Kiwi, on the other hand, due to the fact that Kiwi has been stronger than the Aussie, Euro Kiwi remains in a very choppy consolidation. You can see that we had prices expanding there. I mean, we had a clear up move here, and after that we keep expanding this range, but it's still a range. So between the Euro Aussie and the Euro Kiwi, obviously, if you want to trade it with the upside, the Euro Aussie looks like a better opportunity at the moment. Just look at this massive move higher. I mean, we've had like 2, 4, 6, 8, 10. 10 out of the last 11 days were up days in this pair. We're now testing the 78.6. Obviously, you have to be a little bit crazy to buy it up here after 11 days that almost every single day has been an up day. It's due for some kind of a pullback. The same applies in that regards to the Euro Aussie. So, for example, speaking of the Euros, if we see a pullback, what would that look like? If we make it to the 127.2, pulling back to, the breakout area at 164.50, then could produce, another buying spree for a move towards the 161.8, something like that. Okay. So I think that especially the Euros, you have to pay attention to it because this looks like being a major technical event. EuroCAD, obviously totally different picture, but the reason I'm going to show it is because I remember one of the last days I was here, I was looking and showing this little descending wedge here in the EuroCAD because there was a friend that had asked about EuroCAD, and I said that, listen, EuroCAD looks like it can break out from this descending wedge. Of course, there are better opportunities out there. There are pairs that are moving more strongly. So obviously, if you bought EuroCAD, yes, good for you. You're in the money. But wouldn't it have been better if you bought euros? Obviously, yes. Right. So yeah, but if for some reason you're so convinced that what you should be trading is EuroCAD, EuroCAD has been breaking above this descending wedge, also making good on this RSI divergence that we had. So for the time being, it remains in rebound mode. But as I said before, I think better opportunities out there are waiting for you instead of that. Now, the week before the last one that I had with Greg, I made the week ahead video. I had talked about the opportunity of being short the euro yen. And this has also been playing out very nicely because I was looking for at least a retest of the spike low. And that's what we've already got. So I think that, euro yen has now fulfilled the target. Does that mean that it's going to move higher from here? No, it can rebound somewhat and it can go find the next downside target, which is a confluence of supports roughly at 116.50. So that's the next area of support I would be looking for. Now, one more pair I wanted to show is the Euro Swiss, because when I was here, we were talking about Euro Swiss breaking below this. You can look at it as a rectangle. You can look at it as a slightly descending channel. I said that opens the door, for more downside. We came down to 110. We rebounded slightly from there, but now we've also broken that support area. Okay, so what is the next area of support now? It's this 1.07576 horizontal support area. So Euro Swiss definitely, and it remains under pressure. Keep in mind that it remains under pressure since it retested the previous floor at 120 that happened in April 2018. So it's now been like 15 months. So it's a 15-month drip lower here, right? Now, what does that mean for the USD Swiss as well? You all understand the implications. I think the corrective pattern here was quite obvious in the USD Swiss. As you see, it was in the form of a wedge. We've now broken below it. So I have to tell you that Euro USD might not be that convincing yet, but USD Swiss looks quite nice to the downside. Okay, so 95.80 is the 61.8 from that low, February 18 to the highs that we had in this April. So why not? I mean, we can easily make it down there. Now, the DXY, I posted this on the end of week analysis. The DXY also offered at the end of last week a nice shorting opportunity. Why? Because it tested the triple confluence of resistances up here almost at 99. You can see it's this ascending channel resistance. It's the 127% extension of this corrective move lower. It's also a horizontal support resistance area. If you go back, you can see its significance. So nice rejection from there. It's currently testing another horizontal support resistance area roughly at 97.70. If it breaks below there, then it opens up once again the 96.70 area for a retest as support. So, there can be more downside here in the DXY. I mean, the DXY undeniably remains very, very well bid. It's been in a textbook uptrend since February 2018. Why is it a textbook uptrend? For the most simple and obvious reasons. Because it keeps producing higher lows. Okay. Do I am I surprised by that? From a macro perspective, yes, I am somewhat surprised. But I would be a fool not to follow what the chart is telling me. And the chart, has been saying that we are in an uptrend. It doesn't have any momentum we should be admiring, not in any chance. But as long as we remain above the previous low, which is at 95.84, we can see more upside. But until we get there, there is some more downside that we can see. Okay. Now, if and when we break below 95.84, then there's going to be a lot more stuff we can be talking about, because that's going to be a major signal that something is changing here for the dollar. So, looking for opportunities, multiple opportunities to be short the dollar is going to be what I'm going to be doing. Then you also have to notice, and I know I haven't been watching your questions yet because I had a lot to talk about, but I know that you all will almost always ask about the metals. Keep in mind that the metals remain very, very well bid. Just look at the gold. Gold is currently testing this ascending channel resistance. It remains very, very well bid. There's no question about it.
And this, Steve, also with the yuan depreciating, right? Usually, as USD yuan goes up, gold and silver goes down.
Yeah, and don't forget, Sergio, that until a few days ago, the dollar was well bid, yet gold refused to move lower. It was just consolidating, yes. Right?
Yes.
So that was also a signal. And usually, when you see bonds, metals, dollar being bid at the same time, that is, as it proved once again, that is a signal that you should get as far away from stocks as possible. And you saw what happened in this case. Okay. Now, silver also remaining very well bid. I'm viewing this as a consolidation just below this descending trend line. I would expect that sooner or later, silver has a much higher chance of breaking higher from there than anything else. Hasn't done yet, but that doesn't mean it's not going to do it. As I said, I think the chances are that it's going to happen. When that happens, I think that the next upside resistance is here at 1725. Okay, so quite some distance. I think it's going to be a nice trade to play the breakout. I think it's a viable trade. One more thing I wanted to show having to do with the metals, and that's the gold-silver ratio. A very nice and healthy rebound so far in the gold-silver ratio. But I think that this impulsive move lower in the gold-silver ratio is too big. It's actually huge to ignore. So I think that we're approaching levels that the gold-silver ratio is now giving us again the opportunity, if you didn't take advantage of the first breakdown, to perhaps start sorting it, between here, the 50% fib, and a little bit higher, the 61.8, anywhere close to 90 ounces of silver for 1 ounce of gold, even historically, is overextended. So I think a good opportunity to be playing the gold-silver ratio. There are some brokers that will give you the ability to play that straight forward, through a CFD or whatever. But you can also, in any case, do that synthetically. Okay. How do you do that? by selling the equivalent amount of gold, not weight, amount, right? Dollar amount, for example, while buying silver. This way you can play the spread. Okay, so now having to do with crude. Things with crude are quite simple in my opinion. There is the bearish and there's the bullish case scenario. So what did I just tell you? Almost nothing, somebody would say. Not exactly, because the bear case scenario is very well defined, and I think it's well defined by looking at this head and shoulders formation. You can see that the neckline currently is not far away from where we are. It's just below $54. And there is also the bullish case scenario. In many occasions, as I've demonstrated in the past, what appears to be a head and shoulders formation is a triangle, right, of some kind, something like this. So there's your bullish case scenario. So, if it breaks this descending trend line resistance, then that was a consolidation after an initial move higher, in which case you should look for at least one more extension to the upside towards 63. Now, if alternatively it breaks below this neckline, then you're looking at a head and shoulders formation, in which case you can just extend its height from the breakout point and get the target. I'm guessing it's below the previous low here. Anyhow, we can care about that once and when it happens. So that's my point of view having to do with crude oil. Until either of those levels break, I think you shouldn't be pushing your luck to do something with it. Now, copper, while I was on vacation, finally made it to hit my target, which was this horizontal support area at 257. After breaking below this rectangle, you can see here why trading intraday sometimes is a bad idea. Look at this false break higher we had from this rectangle, and since that false break higher, copper has been on a one-way street. Of course, no surprise considering how sensitive it is to what is happening with China, right? So no surprise there. Keep in mind that if we confirm the breakdown from this horizontal support area, then we have quite a lot of space for the next downside target, which is roughly at 245. So definitely copper has also made a move here, and you should definitely respect it. And finally, palladium. Palladium is risk sensitive. No wonder that it got rejected from there. In the grand scheme of things, you can even call this a double top if we ever make it below this low, because until then it's nothing. Might be part of a larger consolidation. It can absolutely be. I mean, we might have like some oscillation between this 1615 and 1300 area. So like a huge triangle, or who knows what, because with corrective moves you can never tell in advance what kind of a corrective move you have in hand. But that is a possibility. Okay. Let me go through some of your questions. Question about the cable. Okay. Things with the cable are quite simple. I've kept saying again and again, using different formations. I've kept saying the two following things. Whenever you are on support, as we were, for example, multiple times in this potential descending wedge, there is the risk reward in your favor. But what isn't in your favor, and I keep repeating that, is the trend. Okay. So, cable keeps producing opportunities for people that really want to buy it against specific levels. This is one of them, once again. That's why I made that introduction. Why? Because we've been testing the confluence of the 127% extension of the last rebound and the horizontal support area and this descending trend line support you see here in purple. So it's a triple confluence of supports. So should you be buying it? Sure. If you just want to do it from a risk-reward perspective, I mean, you just have to risk roughly like, let's say 100 pips at the moment. And if this plays out, we should see at least a retest of this 123.70. That means 200 pips of upside. So it's a healthy 2-to-1 risk-reward ratio. So purely from a risk-reward perspective, sure, go ahead and play it. Would I be buying it? No, as I haven't been buying it for, I don't even remember when was the last time I tried to buy the cable. I literally don't remember when it was. But, it depends on what kind of trading you want to do. Personally, I just stay away from it. There are better opportunities out there. But as I said, you like it, there you go. I just showed you a triple confluence of supports. At least, you can be buying it and have a very well-defined risk and, a very well-defined risk-reward ratio. So it's a decision that you and only you can make for yourself, nobody else. Same deal here with the Euro USD. Euro USD was retesting once again this descending trend line. It also falsely broke below it intraday to touch the 127% extension of the last rebound. Now, would that be enough of a reason for me to be buying it? The answer is no. I would still rather do something else. Okay, and I've been doing other stuff. Now, since it rebounded from there, can't it rebound even further? Yes, it can. As I showed you before in the DXY, there is, even if this is a corrective move higher, there is